Central banks are built to do one thing well: keep prices stable. But climate change is forcing a second question onto the agenda. How do you support the transition to renewable energy without making inflation harder to control? In India, this is no longer theoretical. It is already showing up in inflation, finance, and the banking system. The Reserve Bank of India has already acknowledged the issue through its discussion paper on climate risk and sustainable finance, and through its draft disclosure framework for climate-related financial risks. But the deeper problem is structural. The main tool the RBI uses to control inflation, the repo rate, can also make green investment more difficult. That is the central tension. To understand it, we need to see that the relationship between monetary policy and climate runs in both directions. Start with the first direction. Monetary policy affects the green transition. In standard macroeconomics, higher interest rates slow demand, reduce output, and can also reduce pollution. But that logic becomes much less straightforward when the investment we care about is highly capital-intensive. Renewable infrastructure, solar farms, wind parks, grid upgrades, depends heavily on access to finance. When borrowing costs rise, those projects become harder to fund. This is where the Indian evidence becomes important. Vilantenkodith, Powell, and Ansari, writing in 2024, show that broader monetary conditions are linked to a lower ecological footprint in India. Pradeep, in 2022, finds that higher interbank rates are associated with higher per capita carbon emissions, both in the short run and the long run. Put together, these studies suggest that tighter monetary conditions can unintentionally slow the move toward cleaner technologies. Now take the reverse direction. Climate affects inflation. This matters because inflation is at the core of the RBI's mandate. Kumar's 2025 study, covering India from 1991 to 2022, finds that temperature fluctuations are statistically significant drivers of headline inflation, and that rising temperatures tend to come before inflationary movements. Sengupta and al. in 2026 reinforce this result. They show that worsening climate conditions push inflation up while also reducing GDP. So climate change is not only an environmental issue, it has become a macroeconomic issue. It is now feeding directly into the price instability that central banks are expected to manage. And the pressure does not stop with inflation. It also runs through the banking system. Banks are the institutions that must actually finance the transition. But green lending does not always produce immediate rewards. Reddy, Panda, and NGO, in 2026, find that green credit can reduce bank competitiveness in the short run. The effect is especially visible for smaller banks, public sector banks, and during crisis periods. That creates a real policy problem. Even if green lending is good for the economy over the long term, individual banks may still hesitate if the short-term incentives are weak. In other words, what is socially desirable may not look commercially attractive right away. There is also a deeper financial risk here. Bandyopadhyay, Roy, and Manikaraj, in 2022, show a statistically significant relationship between corporate default rates in manufacturing and carbon emissions. Their work points to an important conclusion: carbon-intensive business models may become increasingly risky from a credit perspective. Decarbonization is not just about environmental goals. It is about financial resilience too. This brings us to the policy dilemma. The Tinbergen rule in economics says that if policymakers have two separate goals, they generally need two separate instruments. But the RBI is being asked to do two things with one main tool. It is expected to control inflation and at the same time help create conditions for the green transition. That is where the collision happens. Raise interest rates to contain climate-driven inflation, and you may make renewable investment harder to finance. Keep rates lower to support green investment, and inflationary pressures may persist. Trying to do both with one lever risks doing neither well enough. So what is the way forward? The answer is not to ask monetary policy to do everything. The answer is to use different instruments for different objectives. The repo rate should remain focused on price stability. Support for the green transition should come through other parts of the financial policy toolkit. One option is priority sector lending, where renewable energy is already included. Expanding loan limits in that category could redirect more credit toward green sectors without changing the overall interest rate structure. A second option comes again from Bandyopadhyay, Roy, and Manikaraj. They point to risk-weight concessions for greener borrowers. That would reduce the regulatory cost of green lending for banks and make those loans more attractive without relying on the repo rate. A third step is to formally embed climate risk into prudential supervision, treating it as a Pillar 2 style risk, so banks are required to build systems for climate risk assessment and governance. That would strengthen financial stability while improving the quality of credit allocation across the system. The broader lesson is clear. Climate change is no longer outside macroeconomic policy. It now shapes inflation, investment, and financial risk from within. For the RBI, supporting renewable infrastructure while maintaining price stability will require institutional clarity. One tool cannot do two jobs equally well. A climate-resilient financial system will need targeted instruments, coordinated policy, and a clear understanding of what monetary policy can and cannot achieve.